Hey folks, welcome to Macro Crazy, where we try to help you with your macro trading journey. Apologies, I didn't post yesterday like normal, family obligations, but I'm going to try and post two videos tonight. First one is a summary from Zero Hedge about 5 reasons that 60-40 portfolio allocation is completely dead. So hope you enjoy this first video. The second one is the normal one on Sunday nights, basically talking about what's coming up for the week as far as economic releases and how we can trade it. Hope you enjoy. So reason number one is that bonds are no longer a stable portfolio foundation. You learned this in 2022 if you owned any bonds or if you were just paying attention. There were steep losses on government bonds, and obviously the further out you went, the bigger the loss is. 30 years, obviously in the US, we're down about 45%. Something somewhere around there. And if you owned like 100-year bonds, your losses were even more severe. I think something north of 60%. Reason number two, the 60-40 portfolio allocation is dead, is that the negative correlation of stocks and bonds is a myth. In fact, 70 of the last 100 years, it's actually been slightly positive. So diversification isn't nearly as much as people think. And basically you're taking more risk than you may realize if you stick to that allocation method. So reason number three is just carrying on from reason number two. It's the positive correlation nowadays of stocks and bonds, which is going to be an issue and cause portfolio managers and financial advisors a lot of stress. Basically, negative correlation occurs in low inflation environments. Obviously, that's no longer true, and the correlation, positive correlation, is an issue now. Reason number four, bond market situation could become precarious. Basically, obviously as issuance is going up, for the first time in 10 years, demand for US Treasuries has turned negative, which obviously could drive yields substantially higher for multiple reasons. You got quantitative tightening, you got obviously tons of new issuance and demand falling. Very dangerous situation, especially given how many retirement funds, pensions, etc., rely on U.S. Treasuries. So if you want to continue to own stocks, what do you do? Like, how do you stabilize your portfolio if you can't use bonds? And the answer is in the image, gold as a portfolio stabilizer. The argument that's made in this article is that gold outperforms in a recession, which basically we're going to enter in 2023. So gold could, cushion any stock price falls. At the same time, it tends to outperform during periods like this. If you want to take it to the next level, one strategy that is highlighted in this article is basically, go short big tech, technology companies, and then be long commodity stocks. That includes gold and other metals, uranium, and anything else in the energy sector that would help you kind of cushion your portfolio. Hope that helps. And if you liked it, definitely like, comment, and subscribe. Thanks much. Have a good night.